No, it's the return as a percentage. This is 50%.
Okay, okay,
Yeah.
okay, okay. Got it, got it, got it.
Yeah, no, if it returned
Uh,
500%, I'd be gone.
yeah, yeah, yeah. I, I mean, this part, uh, the 90% hit rate is also a bit weird, but given how you are filtering your signals in the beginning, and since it is the fixed income space, uh, just make sure that there is no forward bias, and otherwise, I think it's good to go. I mean, you should trust the system.
Yeah, I know. I know. I have been. So, I mean, do you think it's a bad idea just to say like, hey, keep this within a universe that doesn't have too much volatility and it works? It actually works very well. Once we take it into it, I mean, what I am going to do is the S score. I just messed with the bounds one day and I got a good return. It just with these values, this is you can set this as the bounds. I take it from a paper where they call it the S score, basically. Um, what I'm going to try and do is instead of setting this just for every single pair within the model, somehow use it to where it's going to optimize each one before the trading interval starts, right? So we have a selection, and then on the process XT, I can go in and so I don't know, like one idea I have is take the average of all the peaks, take the average of all the troughs. Those will be our entering positions. And from there, I don't know, I'll try and work out what would be the best way to take the closing positions. That's one idea I have. There's also an issue with the weights, right? If we just want to leave the algorithm, because the algorithm works, the algorithm is good. We're going to use it moving forward for waves for the selection. What I mean for this, this whole strategy kind of just became just like I said, like a Frankenstein, but it works for at least fixed income ETFs. Um, and I what was I going to say? Oh yeah, so I'm going to do this, and then there's also the issue with weights, and that would actually be something that would be useful for waves as well. Is if we're gonna, we're gonna select our universe that we're gonna be trading on for like say the next quarter, 2 quarters, a year. How could I realistically assign weights? There was something in the PCA paper, but I haven't read that part yet. I actually have to go read that part to where how they're assigning it. The only issue I see with that is I think the way that they're trading it is they're treating it almost as like a bucket against an ETF to where like when one of them goes out of pocket, they sell all the others based on the index. I could be wrong, but that's how it that's how I perceived it when I skimmed over that part. But does anyone have any other ideas on how we could possibly use um how we could possibly adjust the weights instead of just doing an equal allotment of our total portfolio value to every single pair?
Uh, for, uh, uh, for this case, you can maybe explore the Kelly criterion for
Okay,
position fitting.
let me just write this down. Sorry, that was for work. I was training someone.
Also, across the different forex pairs, are you getting the same leverage, or is there a different leverage which you are getting?
No. So if we go look at the amounts traded, this is the amount traded. So where beta is well, let's go back to the model. It's from that first paper that we were modeling or that we replicated here. For the beta, I just take these standard deviation of the log returns of each member pair, and then we apply that to the amount invested to account for volatility. Right here.
Got it. So,
Yeah.
in Kelly criterion, it may be more of a probability basis, but I think in case of forex pair, you should have some sort of recency bias, uh, like how a particular pair is behaving off late. I mean, that
Mhm.
should be taken into account.
Okay.
Uh, and I you can also look into one of uh, other position sizing criteria,
Mhm.
which is something like it's safeguards a portion of your portfolio, right? So there is a protection floor, and then there is a cushion.
Okay.
So I believe they call it some sort of portfolio insurance technique, uh, and that is how you size your positions. So essentially, if you are trading on two pairs or say three pairs,
Right.
you need to ensure a protection floor of say 90% of the capital invested,
Right.
and then how much risk you should be taking in addition to that. So that sort of elaborate position sizing can be checked. But
Mhm.
again, that is based on uh, how the past is performing, and I don't think any sort of recency bias will play into it. So you might have to tweak some of the existing position sizing techniques
Mhm.
and play around with any sort of recency bias. It can be exponential decay. It can be some sort of weighted average based on the past 10 business days.
Mhm.
Uh, you might want to check the keyword recency bias and how you can play around with it.
Okay. Cool. Um, yeah. So then just I came up with something. Um, I want to get your guys' thoughts on this as well. I came up with this just to show that the strategy should or could be deployed based on these criteria that I came up with. If you guys want to go ahead and read it, if you can. I don't think everyone wants to hear me just read off what I'm about to just read off the page.
Uh, for the deployment criteria, I believe it's well framed. Maybe you can also add a variance component as well, like beat the overall benchmark in terms of returns as well as volatility.
Okay.
Uh, Sharp ratio greater than three. I mean, it depends on the number of backtests, on the number of pair trades, pairs you test. That will help you settle the threshold for deployment criteria number 3 and 9. I mean, it really depends on how your system is behaving, and
Mhm.
based on that, maybe you take the top quartile and decide on a benchmark for criteria 3 and 9.
Okay.
The rest all seems good, yeah.
Okay. Thank you. Yeah.
Maybe you can also add a, stoppage criteria, that if a particular leg of a pair, uh, which would be some underlying forex pair, if it falls below 5% in a short span of time, then that means a black swan event is happening, maybe in some geographical region or globally. So
Mhm.
that if it is global, then I don't think you should immediately stop trade, but you should tighten your exit criteria But if it is a uh, uh, localized fall in the forex pair, say for example, the Japanese yen versus US dollar fell down quite a lot after Ukraine war, but the euro and USD did not fall as much. Uh, so if you're trading any of the pairs based on the Japanese yen dollar combination, then that would be, I believe, going against your pair trade logic. So if there's an unusual fall in one of the pairs, then you can maybe have an exit criteria uh, for the strategy. Like you can pause the deployment, something like that.
Oh yeah, okay, I understand what you're saying. Yeah. So one of my buddies who wanted to consult me on this also said the same thing. Almost like if one of the correlations starts to, for me, I was thinking there has to be a way to quickly get, because I already know when I'm taking losses. I'm taking loss for some reason. The S score that I came up with works, but it it doesn't take into account the trend. So basically, when I start to trend for longer than say a week and a half, the trend of a week and a half is when I'm going to take the loss, right? Because I could be in a sell order, start to trend, bang, they go the complete opposite ways, and I get smacked and I take a loss. Well, there has to be a way to, like, for me, I was thinking like take the last 6 months of our processes, XT's, her score, and say, well, if my her score has on average increased, aka, we'll just take because it basically just, yeah, we'll take the her score. If it keeps increasing on average for the past, the 6 month her score, then we can pause until it starts to, chill out, because for a process to trend, if we're taking the first moment of the Hurst exponent, it'll be hard to, I mean, it would have to really trend. It would always have to be
Maybe
astronomical for us to be able to say, okay, well, we're going to use the Hurst score as our stop order, or like our stop statistic.
for the
Yeah.
exit criteria, I think instead of going for a Hurst exponent moment, you should consider some sort of momentum technical indicator.
Okay. Okay. I
For the
will.
simple reason being, the Hurst will give you a qualitative indication whether it is in trend or not, and then based on your other logic, you are identifying the direction, right? But when you are already in the position, then you need a more reactive indicator. So reactive indicator would be something like a momentum indicator uh, uh, from technical analysis,
Okay.
and based on the shorter time frame of the technical analysis which you would do, it would give you a strict but more accurate exit criteria.
Okay.
If you see that your exit criteria is hitting quite so often, and mostly in less profitable positions, then you can slowly relax the exit criteria by tweaking around the parameters of the momentum indicator which you choose for your exit criteria.
Okay. Okay. Yeah. Because he was talking about correlations. Okay. And it seems like it's right around there.
Okay.
Zorro, that background. Dude, you look like Neo.
So let's talk. Can we talk a little bit about signals a little bit? I know that Aeson has a few things on his mind, and he wants to share with Gaurav.
Okay. So Gaurav, do you remember last time when we were talking about normalization? So I was looking through some financial statements and I kind of came up with this idea. So let's say we're going to analyze cash flows. So you know how sometimes companies in their financial statements, they're like, oh, the cash flows increased by about 2% or 3%. I was gonna, you know, in a normal distribution, there's an average, there's a mean, there's a standard deviation. So maybe I can analyze many companies' percentage change and then assign a z-score based off of that. So if we're looking at company X, if their financial statements, let's say their cash flows decrease like 15%, how far away from the mean, how many standard deviations away, and based on that z-score we could give them a score. Like if they decrease in like 45%, then that's probably going to be very far away from the mean. So that would be a very bad indicator. So I would give them a very low score in that area. That's kind of what I came up with for this week.
Yeah, that's pretty much on the right direction. I would just caution you to maybe filter out the asset names on the basis of market capitalization, like small cap, medium cap, large cap, because otherwise, if you compare small cap with a large cap and apply the same z-score method, it might not work on that diverse universe.
Would there be any other probability distributions, but like the Poisson, anything else? Would those be applicable?
Sorry, I didn't quite understand. Can you please repeat that?
Instead of the normal distribution, would there be applications of other probability distributions to these?
Yes. So you can explore student T distributions. What we generally see in real world finance is that the normalized returns are student T distributed.
Sorry, what was the name of the distribution? I'm sorry, you're cutting out.
Yeah, I didn't get that as well.
I type it out on the chat.
Student
Oh,
T.
okay.
Oh, the
Student
T
T.
distribution. Yeah.
Right.
Yeah. But the problem with the T distribution is that the math gets more difficult when you try to implement them in your own models, right? So most of the finance literature and academic uh, literature is built around the assumption that the returns are normal in nature, and that somehow makes the entire process easy. Exploring a different distribution is definitely not a radical idea, I would say, but it might make your life difficult. That's what I would say.
Fair enough. Thank you.
Okay, everyone, any more question? We have actually Idris. Can you hear us?
Yeah, Professor. Hi, everyone.
Idris is actually far away. Where are you, Idris?
You're on.
Can't hear you.
Yeah.
You say Iran.
Idris?
Can you see me now?
I can hear you.
I can hear you.
I saw somebody on the beach, but here we go.
Yeah. Hi, everyone.
Hello,
I'm
Idris.
talking from Iran. It's a little bit far away from you. Yeah.
Anyway, so you're gonna join us on campus soon, right?
Yeah, I hope so. I hope so. If the visa process and those things goes well, I'll join you.
Okay. Well, even if you
As
can, you
soon
still
as
could
I-
participate in those calls anyway. You've got lots of interesting
Absolutely,
knowledge. Yes, yes,
absolutely.
yes. You should meet with the team separately as well. You're on the
Absolutely.
you are on the other team. You're with the Charles team, right? The Waves team. Wave
Yeah,
model.
I'm with
Those
Charles
are
and the wave model. Yeah.
Charles, make sure you talk.
We have a quick session about, I think Charles, if I'm wrong, correct me. It's about 2 weeks ago with Charles
Yeah.
and Ryan and also
Okay.
Sam.
Okay, it's
And
important to keep up. Yeah.
Charles has introduced us to the project, and he explained to us what have he done till now. And he gave me also a roadmap to follow that roadmap to keep up with the project, to understand the project better. And I'm on that roadmap that the Charles have given me. He told me to first read about the Hearst exponent in that article that Charles have taken idea from it to implement this project, and also the other articles and some YouTube videos. I'm following those, and I'll if everything goes well and I understand those things, I think the recall from the project for me myself would be much higher, because right now understanding the concept is the main object for me to be able to help Charles and other participants of the team better.
Excellent. Okay, guys,
Done.
we're gonna let Gaurav go because we are 30 minutes up. See you next time, everyone.
Zoro, do you have a little minute? Do you have a minute?
Yes, sure,
Yes.
sir, of course.
All right, cool.